Hi everyone, welcome back to our channel. With soaring interest rate and increasing loan repayment pressures, more and more customers have been consulting us about the interest-only repayment method to relieve their financial stress. Some customers want to convert their principal and interest loan into an interest-only loan, while others already have an interest-only loan, but the interest-only period is ending soon, so they want to extend it. Today, we have a comprehensive introduction of principles, application requirements, and the consideration of interest-only loans. We hope this information will be helpful for you. Firstly, let's talk about the principle and requirements behind the interest-only loans. When the banks approve the interest-only loan, they review it just like approving a new loan. They need to assess whether your total income is sufficient to repay the existing loan. The main difference between the reviewing a principal interest loan and an interest-only loan are as the following. If the bank grants you a 30 years loan term, when approving a principal interest loan, they calculate your repayment amount based on a 30 years term. However, for an interest-only loan, let's say the bank grants you a 5 years interest-only period. Since you won't be repaying the principal during the interest-only period, they calculate your repayment based on 25 years. It subtracts the 5 years interest-only period from the 30 years term. Therefore, when the loan amount is the same, the income requirements for applying an interest-only loan are higher than those of principal and interest loan. At the same time, the approval duration of the interest-only loan depends on the type of the property you own. For owner-occupied properties, banks usually only grant a 2 to 3 years interest-only period, and it cannot be extended. This is because the bank takes the responsibility for ensuring that you do not have an outstanding loan at the time of retirement, forcing you to continue working. However, for investment properties, the approval period can be more flexible. In general, you can apply in a maximum of 5 years interest-only period at once. This is because the banks believe that investment property loans can be repaid by selling the property, which will not affect the borrower's quality of life, making the criteria more lenient. Whether you want to convert from a principal and interest loan to an interest-only loan or extend your existing interest-only loan, we recommend that you first consult your mortgage advisor or the bank to assess it, whether you meet the income requirement for applying for extension of your interest-only loan. For those customers who want to apply for extending interest-only loan, it is more beneficial to switch to another bank rather than staying with the current bank, because you may face the inability to extend your loan period when applying from the existing bank. This is due to the following 3 reasons. Firstly, different banks have different banks' policy, and even the same income, the result of the application may be different. Secondly, the calculation of the long-term difference. Since you have already made the payments for several years of your current bank, switching to a new bank allows you to apply for a new 30 years loan term. As mentioned earlier, with the same loan amount, the longer of the loan term, the lower of the monthly repayment amount result in a lower income requirement from the bank. Therefore, while your income may not meet the requirement for an interest-only loan with your current bank, it may be sufficient when applying with a new bank. Thirdly, it will need to understand the loan-to ratio, which is the LVR we called. For example, if you want to apply for an interest-only loan for an investment property, and your previous loan-to ratio was 60%, but now the property price dropped. Based on the current property value, your loan-to-value ratio has increased to 70%, exceeding the bank's upper limit of the investment property's loans. In this case, your current bank cannot extend your interest-only period. If you apply in a new bank, this application can be classified as a refinance, which is not subject to the high LVR ratio quota set by the Reserve Bank, extending in from the LVR requirement. And it also offers the fast approval and favorable interest rate. There are many benefits to switching to a new bank. When applying for a refinance, your mortgage advisors can review your current loan structure and conduct a full financial health check to identify the areas that can be optimized. This can help you to increase the flexibility of your loan, protecting your asset and reducing the bank's control over all your assets. In addition, when refinancing your loan to a new bank, you may also receive a cash rebate that your current bank cannot provide. You should note that there are certain costs associated with refinancing to another bank. For example, if you haven't completed the full term of your current loan at the existing bank, you will require to repay the cash rebate provided to you by that time. In addition, there will be the costs such as lawyer fees and breaking fees associated with switching banks. We believe that through this video, you can see that applying for an interest-only loan is not as a simple matter. It requires careful considerations and calculation to make the most favorable decision. If you have such plans, we recommend you consulting your mortgage advisors or contact with us. We hope today's content have provided you with some insights. Based on your situation, we will provide you a specific advice. If you need our assistance, please get in touch with us and let us conduct a comprehensive assessment for you and tailor a personalized solution. Thank you again for watching our video. We'll see you next time.